Welcome to Colorado, where the housing boom that felt unstoppable just hit the pause button and nobody's sure how to restart it. Number 10, Crested Butte. Let's start in Crested Butte, once the postcard-perfect mountain escape where second home investors were throwing money at any property. The market has finally started to cool in a meaningful way. Sales are down overall, even though the broader Gunnison Valley posted a 6% sales increase. Dollar volume in Crested Butte specifically is declining, which tells you prices are moderating across the board. Inventory is climbing for the first time in years, giving buyers actual options instead of panic decisions. List price reductions are becoming a normal conversation at real estate offices. Properties are sitting noticeably longer on the market. The scarcity mentality that defined the market from 2020 through 2023 has completely evaporated. We're not talking about a catastrophic crash, but a genuine slowdown where sellers are finally adjusting expectations and deals actually require negotiation. Number 9, Winter Park. Moving east toward Denver, Winter Park was once considered the affordable alternative to Vail and Aspen for Denver metro residents. That reputation is completely gone. The median home price now hovers between $900,000 and $1 million, with rents climbing just as aggressively. What made Winter Park attractive 5 years ago was the combination of lower prices and proximity to Denver. Now it offers neither advantage. Front Range residents seeking mountain access drove prices through the roof, squeezing out the locals who built the community. Inventory has expanded significantly from pre-pandemic lows. Days on market have climbed noticeably. Population and school enrollment are declining, a sign that families are voting with their feet and leaving for towns where a teacher or nurse can actually afford to live. Number 8, Vail. Heading deeper into the mountains, Vail presents a completely different problem than Crested Butte. The median single-family home price sits around $1.2 million. When you add average HOA fees exceeding $2,000 monthly before any taxes or maintenance costs, you're looking at carrying costs most workers cannot support. Inventory is rising steadily across the Vail Valley. Days on market have increased year over year, meaning homes are taking significantly longer to move despite aggressive marketing. The real underlying issue is workforce crisis. Essential workers, from teachers to restaurant staff, literally cannot find housing within reasonable commuting distance. You have a town full of stunning second homes empty most of the year and a shortage of service workers to actually staff the restaurants and resorts. That's unsustainable. Number 7, Telluride. Down in San Miguel County sits Telluride, where the ultra-luxury market is definitely experiencing a slowdown. First quarter 2025 showed dollar volume down 27% compared to the same period in early 2024. High-end sales, those properties selling over $5 million, dropped dramatically from 18 sales in early 2024 to just 7 in early 2025. The market has 243 properties currently listed, and at that inventory level, you're definitely seeing longer marketing times. However, the market is not in freefall. Deed-restricted condos for locals priced under $1 million continue moving briskly at just 38 days on average. Overall, prices are not retreating. Telluride's ultra-wealthy owner base means sales volume fluctuates dramatically based on emotional and economic factors rather than pure market mechanics. But there is absolutely a measurable slowdown happening. Number 6, Steamboat Springs. Steamboat Springs tells an interesting story because it's actually holding up better than most other mountain towns. The median home price sits at $1.4 million as of early 2025. Inventory is up 57.3% year over year, which is substantial. Days on market average 62 days, a reasonable time frame in this environment. The town has shifted to what market experts call a balanced market with 5.9 months of inventory, meaning buyers have real negotiating power for the first time in years. The concerning statistic is commercial real estate, where sales volume collapsed 53%, dropping from $6 million to $3.2 million. That signals that investors and business owners are staying firmly on the sidelines while the market settles. Number 5, Aspen. In Aspen, the narrative is more nuanced than catastrophic. The median list price for homes is $16.25 million as of October 2025. Average days on market runs 250 days, which sounds brutal until you understand that ultra-luxury homes always move slower because there are only a handful of qualified buyers globally. The important data point is that Aspen home values are actually up 0.2% over the past year, according to Zillow. Price per square foot actually rose from $3,670 to $3,725. This is not a collapsing market. It is a market where inventory has accumulated to 103 homes for sale, giving buyers actual options and time to think. The ultra-wealthy still think Aspen is worth the premium pricing. They're just less desperate to close quickly. Number 4, Breckenridge. Throughout Summit County, Breckenridge is the epicenter of the shift happening across Colorado mountains. Inventory jumped 34% compared to July 2024 and is up 92% compared to 2023, a staggering increase. Median home prices are down roughly 10% from the peak that occurred in 2023, currently sitting around $1.6 million. Days on market are at 78 days, up 19 days from the prior year. Sales volume is actually up 17.1% in total transactions, but that's because activity is dispersed across many properties at lower velocities instead of fierce competition driving quick closings. The market has fundamentally shifted from a seller's advantage to genuine neutrality. Number 3, Denver. In the city of Denver property, single-family homes are down 3.6% year over year. Prices dropped from a high of $615,000 in June 2024 down to a low of $565,000 in January 2025 before recovering slightly. The close-to-list price ratio sits at 97.2%, which means sellers are not commanding premiums and buyers have actual negotiating room. Approximately 45% of homes have seen price reductions. Days on market are up 18% year over year. The narrative in Denver is clear. It's shifting from a seller's market to a genuine buyer's market after 3 years of extreme scarcity. It's not a crash, it's a recalibration where inventory is finally matching buyer demand. Number 2, Boulder County. Boulder County is facing more serious headwinds than Denver. In August 2025, prices were down 10.3% year over year. The median home price dipped to $845,000 in January 2025, down about 9% from the previous year. Current data shows average home values are down 6.1% over the past 12 months. Days on market jumped to 110 days from 88 a year ago. The market pace that used to close homes in 48 hours now routinely takes 48 days. That's a seismic shift in buyer leverage. Boulder's geography limits housing supply naturally, but remote work and rising affordability concerns are tempering demand for homes priced at nearly $1 million. Number 1, Gilpin County. Gilpin County presents the most dramatic story, though context matters significantly. In July 2025, prices showed a 24.7% decline according to Colorado Sun reporting. However, more recent October 2025 data from Redfin shows prices actually up 30% compared to last year, selling at a median of $715,000. The market is incredibly small, with only 7 to 12 homes selling monthly, meaning individual sales create huge percentage swings. Days on market jumped to 110 days from 57 prior year. The real story in Gilpin is extreme volatility. It's illustrative of rural Colorado markets experiencing wild swings. That's the real story of Colorado real estate in 2025, not a crash, but a reset where inventory finally meets demand and buyers have leverage again. If market shifts matter to you, like and subscribe for more deep dives on where real estate is actually headed.